So let me kick off. So welcome to the first webinar that we're doing under the NPO network, and this is specifically to do with running a business and the legality around that. So what we've done, we've composed a whole list of hard questions for Michelle to answer. So here's your first question is, why would an NPO want to start a profit-making activity within their organization?
Okay, that is always a good question to start with. Our economy and the world that we live in at the moment is very uncertain when it comes to funding and income for non-profit organizations. Foreign governments withdraw from South Africa and other countries based on their own criteria and often with little notice. We're all kind of fighting, as it were, for quite a small pot of money that is held by government and by corporate social investment. And so we have little control over where the money is going to come from, and particularly when you're dependent on funding. So a business gives you an element of control over the income that you raise. Also, it's unrestricted, and that's absolutely key for a non-profit organization. These donors are more and more tight in what they fund and how they fund, and being very specific about what you can spend the money on. So to have a source of unrestricted income really allows you to focus on some strategic initiatives and cover your core costs. And finally, I think just because we're a philanthropic sector, and we realize the benefits of caring and sharing and all that kind of thing, it does also give employment opportunities for people who wouldn't necessarily be employed in the sector in any other instance, people who would be more suited to a business arrangement. So that's a couple of reasons why it is often a good strategic decision to start some kind of business activity.
Okay. So help me out, Michelle. There's this name called non-profit organizations. Can a non-profit make a profit within their financial year? Explain the accounting logic, because that doesn't make sense to me.
Okay. This is a huge confusion, particularly for people who are not in the sector. Non-profit doesn't mean that you don't make a profit. It means that your profit is not distributed to the ownership, or the ownership is not like you would have a shareholders or something such like that in a private company. You have a governing body, and they're not receiving any financial benefit from so-called owning that organization. The profit has to be reinvested in the organization itself. Okay. However, you can make a profit. We typically call this a surplus, and the surplus can be made in a number of ways. Often you end the year with donations and grants that are unspent. Sometimes those are designated for a period that crosses your financial year, so you have to hold that money in trust until you spend it in accordance with the agreement. Sometimes it's things like your fees and donations and other unrestricted income that you've received that you are holding back and don't need to spend. And it may be things like investment income and interest and so forth. So yes, absolutely, you can make a profit as a non-profit.
Okay, cool. So if a non-profit then is all about social and upliftment and all that sort of stuff, are we allowed then as an NPO to conduct trading activities for a profit, to make that profit?
Yes, there is no legal limitations on what a non-profit does and how it generates its income. And we're using the word profit, but sometimes it's a loss.
Mm-hmm.
But even a loss can be beneficial to an organization because it can cover some core costs. The income can cover some core costs even if it doesn't actually make a profit in and of itself. But I do want to just note that not everybody chooses to conduct trading activities, even though you're legally allowed to. Some organizations are not structured in a way that it makes sense, particularly when it comes to management and the commitment in terms of engaging with trading activities of whatever kind. And sometimes the time and the people time and the cost and all that sort of thing isn't worth the benefit. I have clients who get large international donation or grants from foreign government funds, and for them to do a little bit of trading on the side and sell some of their workshops to corporates for a fee just doesn't warrant, the income just doesn't warrant the effort in terms of their budget. So it is a choice, but it is definitely something that is worth investigating and looking into to see if it is suitable for you as an organization.
Okay, so instead of ROI, we've got ROE, return on effort. And that's something that we would most certainly look at and stuff there, because I agree, there's a lot of our normal for-profit clients that their return on effort is way out of kilter, where they work themselves to death and at the end of the month there's nothing. So that's a good indicator with that. Okay, so this afternoon we heard the budget speech and taxes and all that. So that's on top of mind for everybody now, and we're not going to be paying more tax and all that sort of stuff. But does a non-profit company who's making a profit, is that still exempt from paying tax?
No. So okay. I think an assumption that people make is because I'm a non-profit, I therefore am automatically exempt from income tax. I don't pay tax. And that's not the case. All of your taxable income is taxed in the hands of the non-profit. You can apply for public benefit organization status with SARS. If you achieve public benefit status, then your income is, some of your income may be exempt. There are a number of other benefits for being a public benefit organization, and I'm not going to go into those today. But there are 4 specific circumstances where a public benefit organization, and I say that specifically because it's not applicable to all nonprofits by default, where your trading income will be exempt from income tax. Okay, and the first circumstance is where the trading income is directly integral to the objective of the organization, the primary object. It's done on a mostly cost recovery basis, and it doesn't create an unfair advantage to the nonprofit organization. I think this is a key element to consider. When SARS put these rules in place, they recognize that because nonprofits can pay no tax, because in costs, staff costs and things can be covered by grants and donations, there is a possibility that the trading activities will be done in a way that is unfair to those who are running a profit-making business and have to pay all of those additional costs out of their income. So the way that the trading activity is structured, what to charge, things like that, should be market related and not as an unfair advantage to the non-profit. So that's the first circumstance, where it's integral, based on cost recovery, and not unfair. Mm-hmm. The second circumstance is where it's occasional and mostly utilizes volunteers. The most common example for this one is fundraising events, your golf day, your dinner, your fete, your fair, whatever it is, your festival, whatever it is that you're doing, where it's occasional. Annual can be occasional. It's not part of your core business, your core or non-profit activities of what you do. And for the most part, those kind of things are either done by staff or volunteers. You're not contracting additional people in to raise that money. So that's the second one. Then the third one is by special permission of the minister. There are certain considerations that the minister takes into account when allowing specific trading activities to be exempt upon your application. And really it's along the same lines as I mentioned before with the unfair advantage, where the receiver doesn't want to allow the exemption if it will be detrimental to other profit-making entities in the economy in some way. To my knowledge, and there might be some others who know this, but to my knowledge there's never actually been an application for the specific thing. Most trading activities fit within one of the other three categories. So we've covered whether it's integral, whether it's occasional, whether it's applicable, exempted by the minister, and the final circumstance where a public benefit organization can have tax-exempt trading activities is within certain thresholds. So if it doesn't relate to your primary objective, but you're going to do it anyway, you are allowed a certain amount to be tax-free. The calculation is 5% of your total turnover. Mm-hmm. So you calculate your total turnover, you see what 5% is. That amount, or 200,000, whichever is greater, is exempt from income tax as trading activities. So I think we'll talk a little bit later on what happens when that amount, your trading activities exceeds the exemption. Mm-hmm. But for now, I can just say that there is a minimum amount that can be exempt from income tax. So for me, the key takeaway, and to get the details, you can go and have a look. We'll send you the details of a white paper I've written up on this so that you can get the technical details. But the key takeaway is that your objective needs to be broad enough to cover whatever it is you want to do, mm-hmm. while still being specific enough to actually have meaning and to indicate to donors and so forth exactly what it is that you do and who you are. Yeah, so in most cases the trading activities will fit within the integral to the objective because the objective is broad enough.
Okay, all right. And you glancing over a technical term, integrated to objectives. Where would one find objectives within an organization if you weren't kind of the founder and you've just arrived at an NPO? Where does one look for the list of the key objectives?
Okay, so just to clarify, we're not talking about a multitudinous list of objectives that you would have for each year in terms of your strategic planning. This is what we want to achieve this year. There is one specific sentence, typically it's 1 or 2 sentences at most, that dictates exactly the purpose for which the organization was created. Mm-hmm. This is why you exist. Okay, and that is found in your founding documents. So if you're a trust, it will be in your trust deed. If you are a non-profit company, it will be in your memorandum of incorporation. And if you're a voluntary association, it will be in your constitution. But that specific sentence is what guides the purpose of the organization from its inception onwards.
Okay, brilliant. So hopefully we haven't lost those documents. And if people have lost those documents, then we're in trouble, huh?
Kind of.
Okay, all right.
And the trust deed, just to answer that very briefly, a trust deed should be lodged with the Master of the High Court.
That's
so you should be able to get a copy from the Master. Mm-hmm. The Memorandum of Incorporation is not always lodged with CIPC, but you may be able to get a copy from there. You may also want to edit or institute a new or revised version. So if you really can't find one, you might want to actually create one from scratch.
Okay.
And then the governing body at the time then signs that into being.
Okay, perfect. So not all is lost if the paperwork's gone. All right. Okay.
Oh, sorry.
Let's go.
The last other place is that the Department of Social Development might have a copy.
Yes. Okay. All right. Or your mother. Okay. All right. Let's get back into some numbers and income tax says. So you mentioned that a PBO could exceed their limitations with this, and there's a couple of calculations in that. If an organization like this exceeds those limits, do they then lose their tax exempt license status?
No, it changed as of 2006 to what they call partial taxation, where you are taxed on the portion exceeding the basic exemption, but it doesn't jeopardize your public benefit status at all. So you are able to make as much money as you can.
Okay, that's brilliant. Okay, so maybe you can share briefly without confusing us all, because it is evening and people have had a long day. How is the tax on the trading activities calculated? I know it's covered in the white paper, but maybe you can just give us an overview.
Okay, yeah, I'll try and be simple. We'll see. So the first thing you need to do is establish what is your basic exemption. So it's not a fixed amount. It is 5% of your total turnover or 200,000, depending which greater. So you have to first work out what is 5% of your total turnover. Then you know what is your maximum, and you can see whether that is greater or less than the 200,000. Then you need to see of your trading turnover, how much of that is exempt. What's the split? So for example, if we made a turnover for our trading activities of 300,000, okay, and assuming that the maximum, the greater of in our basic exemption calculation was 200,000, we'd then be able to say, okay, of the 300,000, 200 is tax exempt and 100 is not. Okay, so we have a 1-to-2 ratio. Okay, then you say you work out what your taxable profit is. Okay, because tax is calculated not on your turnover, but on your profit. So you have to work out what are your expenses that you can deduct from your turnover. And there's obviously the cost of sales and things like that, staff times, and the direct expenses that you would have relating to the actual activity. However, you can also assign a percentage of the organization-wide overall costs. So for example, you have accounting fees, audit, bank charges, things like that that are not specific to the trading activity. You can then apportion part of that to your trading activity in order to calculate your profit. Once you have a profit, then you work out which ratio of that profit is exempt and which ratio is taxable. So we had the 300,000 to start with the 200 to 100, you would work out your profit in the same ratio as your turnover between exempt portion and not exempt portion. And often you might find that actually in reality you're not looking at a profit, you're actually looking at a loss because you've applied as much expenditure as you possibly can to that tax trading income. But if you do actually have a taxable profit in that percentage, then you apply the company's tax to that, which is 28%. So all the way down from these things, you can see that in the end, what you're actually doing is paying 28% of potentially a very small piece of the income that you have generated by having a trading activity. So I would always say that, a little bit of tax for the benefit of having that income is definitely worth it, especially if you're able to use some of that income to cover existing costs of the non-profit organization.
Those as well. So thank you very much, Michelle, for your time. And thank you very much for those of you who managed to scrape some time out of your day to come and join us, and enjoy your evening. Thank you and good night.